markets were cheered by last week's US inflation numbers. Mind you, they were only modestly better than expected and showed just a tiny decline. This week we get the UK numbers, and they should be a lot better than they have been, with the prospect of inflation here being at or around the Bank of England's 2% inflation target for the next 12 months. And at the end of this month, the Eurozone inflation figures should also show an improvement. All this very good news should pave the way for rate cuts to start in June. How far they go beyond that, though, obviously depends on the data. In Europe and the UK, the inflation outlook is set fair. And although both economies are improving, especially in the UK, we expect the respective central banks to cut rates further than the markets are currently pricing. That pricing at the moment sees rate cuts by year end of 68 basis points in the Eurozone and 56 basis points here in the UK. And we expect the outturns to be nearer the 1% mark. Matters are more murky in the US. The inflation there has been rather sticky of late. In particular, as we have discussed many times in previous weekly perspectives, the bizarre treatment of rent in the US CPI could keep the inflation numbers up higher for longer there. The good news for rate cuts will depend on a significant economic slowdown that we expect is underway right now. In short, the US consumer has been spending ahead of their income and they're due for retrenchment. Buoyant US consumer confidence, well, that's been powering spending over the last year or so, but it started to slide, and we expect further softness in consumer spending. It's already evident in the retail sales figures. Now, this is nothing spectacular, to be sure. Don't expect recession or anything like that, but it should take the edge off growth and generate renewed downward pressure on prices. Meanwhile, the economies in Europe and the UK are going in the opposite direction. They're growing more rapidly. But this is coming off a low base, a mild recession in fact, and so it shouldn't be a barrier to rate cuts. Indeed, the UK, which had one of the worst performances last year in terms of growth and inflation, well, that should look much better on both counts. We had data last week on GDP, which showed firm growth and much stronger than expected, and that should be a pattern we see continuing over the balance of this year. So, global economic recovery, falling inflation, lower interest rates, that constitutes a very favourable background for financial markets, and we see further gains over the balance of this year. Well, until next week, goodbye from me.